Hello and welcome to this Monday edition of FreightWaves Now. I'm your host Anthony Smith, and we have a strong start to the week. We have Luke Falasca coming up. He's going to give us a broker update. We also have Mike Baudendistel here with us with a Rail Intermodal update. But first, we're going to go to Zach Strickland with the carrier update brought to you by PowerFleet. Stay tuned.
Everyone, and welcome to your Monday Carrier Update presented by PowerFleet. I'm Zach Strickland, and today I'm going to break down a little bit of trend analysis of what we're seeing in the pricing of the dry van truckload market. So obviously the dry van truckload sector is the largest sector of the freight market itself that moves in the domestic United States over the last several years. And so it's a very important thing to understand the difference between contracted freight and spot market freight. A lot of what gets reported is on the spot market. That's the very public, visibly, very available spot market information. If you go to some of these load boards, you'll see some sort of average of spot market activity, et cetera, in terms of rate per mile. But what I have pulled up today is the Cass Truckload Line Haul Index. We've talked about this before. If you've been watching What the Truck and various other podcasts that we do, we talk about this extensively. So the Truckload Line Haul Index is really a measure of, what the actual cost is for moving a truckload across the United States. And I have the Truckload Carriers Association driver revenue right over the top of it. So you can see it's a pretty correlated figure here. So driver revenue per week, moves up with the Truckload Line Haul Index, and then it starts to come back down as the Truckload Line Haul Index falls itself. The thing that you can't really tell here is where's the spot market moving in between here, and that's what I'm going to show you here in just a second. But Truckload Line Haul Index, a good measure of contracted freight. Not that it doesn't have a lot of spot market influence in here, but as the contracted rates increase, as they did back in 2017 into 2018, they slowly started to claw back down, and that's because they operate on this annual cycle. It takes a lot longer for that to happen. And then here at the beginning of the year, right before COVID, and all that in January, we had this huge drop. That's because we had a lot of annual bids come due. They were implemented at the beginning of the year. A lot of rates fall, and you can see that has a large influence on your revenue per driver per week. So much less revenue to work with now, and that is the single biggest driving factor in what carriers are going to expect this year. So we had 2019 operating up here off of 2018 style pricing, and now they're starting to get this 2019, which was a very depressed year for freight. Pushing some of these rates way down, having to claw back some of that rate increase that we saw back in 2017, 18, et cetera. So here is the line haul index with the spot market. You can see that here's our average DAT van long haul freight rate, we use for futures here. You can see that fell really fast in 2019 and stayed down low. Line haul index stayed real sticky, stayed elevated because they were operating off of annual cycle type pricing. So again, the spot market falling down. You can see down there at the very end, there's the COVID impact as we've bounced and is now on its way back up. So we can look forward to seeing some form of recovery in that, but it will not come due on the Cass line haul index until next year potentially. And again, that depends on whether or not the spot market rate stays elevated or not. So some good news is that we have the Outbound Tender Rejection Index. Now this is the underlying measure of how you can see spot market activity. As this number increases, that's what's happening before a lot of this freight hits the spot market. It'll hit your route guide positions 1, 2, 3, then hit the spot market, or maybe just 1 and 2 and then hit the spot market. But as carriers are rejecting their freight, that's going to imply a lot more spot market activity. So 8.61% to start the week. Again, one of the highest values we've seen since this big Devil's Tower looking anomaly that we had back there when COVID was really getting going. So overall in the United States right now, we're seeing a lot of green on this map, and that implies that all of these markets are showing some sort of statistical increase in that outbound tender rejection rate. So this is sorted by the largest markets in the United States, and you can see this column right here, outbound tender rejection, volatility. A lot of green starting to show up in some of the largest markets in the United States right now. We've got Dallas continuing to stay strong, Ontario, Los Angeles, of course, Southern California really driving most of this right now through the United States. But you can see it is starting to be a lot more pervasive in the United States. So pay attention to your spot market. That'll do it for today's Carrier Update.
The comprehensive logistics offerings from PowerFleet cover in-cab ELD, fleet management, trailer tracking, cargo monitoring, and tracking other assets such as chassis and intermodal containers. Power up your operations with PowerFleet.
Hi, good morning, everyone. I'm Luke, bringing you another broker update, and we're going to thank Zach for kind of giving us a little breakdown on the relationship between spot and contracted freight. So right now, as we continue to look at this freight, we're looking at the overall truckload volume level here in the United States. Keep in mind, the vast majority of this is contracted volume, which is important because as that continues to increase, that is going to tighten up capacity and force more of that to spill over onto the spot market. But as we can see here, generally, when we have this big surge after Memorial Day, we tend to float pretty flat all the way through until July. As you can see here, volume levels are continuing to tick back up further and further. That's that blue line. We're looking at 2018 in orange and 2019 in green. So you can see here that there was a little uptick around this time in 2018, but not substantially, not what we're seeing right now. That's a pretty strong increase, so we'll see if that does continue, but that is going to continue to tighten up capacity. As we see on this next chart here, let's look at the tender rejection rates, see what's driving. Now keep in mind, about 80% of freight is dry van freight right now. That blue line that you see there, that is the dry van tender rejection rate sitting at just over 9%. Directly below that in orange is the overall tender rejection rate sitting at about 8.61%. That's going to include all modes of transportation. Up here at the top, you've got reefer tender rejection rates representing approximately 12 to 15% of the volume. So that's sitting. That is moving up, not quite at the same rate that dry van is recently, but it is continuing to push higher as that sits just below that 13% mark. And then down here at the bottom is your flatbed tender rejection rates down there in green. They have not seen much love at all so far this year. Very, very suppressed, still below 5% versus dry van and reefer are definitely leading the charge. So as these numbers continue to push up, particularly on the dry van and reefer markets, you're going to continue to see upward pressure on spot market pricing, as well as more freight move to the spot market as shippers, as routing guides tend to fall apart as the capacity grows tight. Now, to take a look at the map here that we're going to look at, this right here is the weekly tender rejection change here in the United States. The markets in blue have the greatest increase in tender rejections over the last 7 days. The markets in red have the greatest decrease in tender rejections over the last 7 days, and the markets in white are a slight uptick over the last 7 days. So a lot of white there, those are the moderate increases, but look at the blue. A lot of blue down here, especially in, around Arkansas, Mississippi, Missouri, a lot of tightening in capacity here. Great opportunity to call to potentially land some new loads or some new customers in those areas. If you do already have existing customers, perfect opportunity to hopefully help them out as they're experiencing tightness in their routing guides. Also down here in the border of Texas, around southern Georgia, like Savannah, seeing a little bit of tightness. A lot of loosening up here in the northern markets like Montana and different areas of the Dakotas. There's not a lot of freight up there, but if you do happen to move freight up there, I would lower your pricing because it is going to be softening up a little bit. Let's go ahead and look at Jackson, Mississippi, though, because that has seen a massive surge over the last few days, 20% day over day, and even and over 150% over the last 3 days. So you notice here, this is the tender rejection map here, so you can see Jackson, Mississippi, very, very dark blue. Look at this surge. Not 3 days ago, we were sitting at under 10% tender rejection rates for dry van. And we have surged all the way up to over 26%. That is a massive increase in tender rejection rates. And this green line right here, that's that volume level surged right along with it. So a big increase in volume levels that are driving those tender rejections, and that'll do it for today's broker update.
Welcome to your Rail Intermodal update. I'm here with Mike Baudendistel. Mike, what's the latest?
So I've been talking to you a lot about the railroad volumes and how those have fallen off. Different today and talk a little bit about their costs. And most of this we're going to get when the companies report earnings in about a month, a little less than a month. But we do have some sort of interim data on labor statistics and those things. So this is from the Bureau of Labor Statistics. We see railroad employment levels basically just at a high level. 2018 was relatively flat in a growing freight market. 2019 you saw steep declines. Particularly as some companies like Union Pacific, really saw double-digit, declines in the number of employees, while rail traffic was down 4 or 5%. So you see, in blue was in the last, was the current, data, and you see that, that compared to the year ago period. Now this does include passenger. If we just want to take a look at freight, this is a table from the Surface Transportation Board. So that's the governing body that oversees the U.S. Class 1 railroads. And so a couple of things stand out here is in May, in the middle of the month of May 2020, you see that total employees down 17% year over year. So quite a lot. And then in May, that's down 4.5% from April. So this is the data that just came out, and when you sort of slice this down by job description, you see it varying across categories. The ones that are the most economically sensitive are these transportation, train, and engine employees, and those were down about 27% year over year. So that what stands out to me, there is not only are the most economically sensitive, but you're seeing the railroads build longer and heavier trains. So that's the one category that stands out as having a more than one for one takeout of costs for the volume decline. So that sort of indicates that maybe shippers, their service levels might not be as good if there are fewer train departures. Some of these other categories are all the categories are down. One that was maybe less surprising, maintenance of equipment, maintenance employees, those down about 18%. Those are employees that are capitalized. But we knew this was going to be a year where there wasn't going to be a tremendous amount of investment. But really, what stands out is the train and engine employees down 27%. This just putting this into context of what the volumes have been doing. Here this is the rail carload data on the left. Blue is 2020, and you see those were down. Certain weeks they were down 30%, but for the most part down 24, 25%. The latest week is down about 20%. Intermodal, which is closer to you, that got down into the high teens, but lately it's been down slightly less than 10%. So very varying differences across carloads versus intermodal containers. The carloads are likely more profitable, but this is also where they're able to take out a lot of costs, running fewer cars through classification yards and those things.
Excellent, Mike. This is amazing information. Thank you so much for that update, and thank you so much for tuning in. That's going to do for this Rail Intermodal update and this episode of FreightWaves Now. The content doesn't stop here. We're always streaming around the clock, so check out our FreightWaves TV app and all your favorite streaming platforms, including Apple TV. Thank you so much for tuning in, and we'll see you on the next episode.